welcome to today's webinar, where we're launching our new spend-based emission factors for New Zealand. Thank you very much for making the time to join today's webinar. My name is Jeff Vickers, I'm Technical Director at thinkstep-anz, and I'm joined by my colleague Katharina Bauch, our Head of Carbon. And we're going to talk through today use cases for spend-based emission factors and then what's new in our new release. Many of you are already using spend-based emission factors, and so I think we'll focus today on giving an update on what's new in the version 3 release. We will do an update first, though, an overview of what spend-based emission factors are, what typical use cases are, just for the remaining people in the room who are less familiar with them. So the topics that we want to address today, those general things first. So firstly, what are spend-based emission factors? Then what are typical use cases for them? So whether you're using them for purchased goods and services or financed emissions or other things. We're going to cover how are they used, why are they used, when would you use them? And then the last part, and it's the part that I'll cover in this webinar today, is what's new in the 2025 release that we're releasing today. So I'd like to hand over to my colleague, Katharina Bauch. Katharina is our Head of Carbon, and she's going to answer some of the more general questions first.
Thank you, Jeff. And yeah, thank you for laying out the 4 key questions that we will be addressing today. I will dive straight into it, and we start with the first one. What are spend-based emission factors? So spend-based emission factors represent the average greenhouse gas emissions associated with each dollar that you spend in a chosen sector. So say the construction industry or IT services that you purchase. They're expressed in kilograms CO2 equivalent per dollar. So you can apply them directly to your financial data, your spend data, which makes them relatively easy to use. However, because they rely on monetary values, they are more sensitive to price fluctuations than emission factors based on physical units. Since we've seen a lot of you already using these emission factors, I will keep this quite short and then jump to the next questions where we look at some of the typical use cases. So we see 4 primary areas where spend-based emission factors are applied. Corporate carbon footprints, where they're quite often used to estimate Scope 3 emissions, for example, for purchased goods and services. So this is an area where companies often deal with a large number of smaller suppliers, making the detailed data collection potentially quite challenging. Another common application is the calculation of an investment or lending carbon footprint, often referred to as financed emissions. Spend-based emission factors can support financial institutions here to really better understand the climate impact of their portfolio, so their capital allocation, and then they can make more informed investment decisions about where and how they direct their investments. Where does the money go to? This can be used for researchers and policymakers, aiming to understand the carbon footprint of a whole sector, a demand-side sector, so a sector where resources are consumed rather than produced, and then provide insights that can guide policy and strategic decisions. The report that you can see in my slide right now is a report that Jeff prepared for the Parliamentary Commissioner for the Environment in 2020 on tourism's carbon footprint in New Zealand. And with the tourism industry being one of those kind of strong demand-side industries, the spend-based emission factors were really essential for that. And that really was also the genesis for the emission factors Jeff will be presenting in a moment, as he started out trying to update earlier existing work that has been done by Motu here in New Zealand more than a decade ago now, and then realized that Stats New Zealand has been really busy putting out a heap of new data sets that could be really used to improve the spend-based emission factors. And so that's how it started, and here we are. You can also use spend-based emission factors to calculate your own personal carbon footprint, helping you to understand and manage your own climate impact. Out of the 4 use cases we see here, the first 2, the corporate carbon footprint and the financed emissions, are the most common applications I see here in my daily work. And we will now take a closer look at how the spend-based emission factors are used in practice, and with the focus will be on those top 2 use cases. At the start of corporate or financed emissions reporting, data availability, as you probably experienced yourself, is often a key challenge. So this is where spend-based emission factors offer a really practical way to begin, leveraging procurement data that most of you already have in their finance system. And they're especially useful to identify where emissions are likely to be most material, and then where to focus your effort on to improve the data quality going forward. So it's really important to remember though, that these spend-based emission factors give you a directional estimate. It's not a precise carbon value. And in that sense, the spend-based emission factors really should serve as a stepping stone towards more detailed activity-based emission factors and inventory over time. So they are a starting point, not really the end goal. And in addition to helping companies get started and identify hotspots, I assume a lot of you use spend-based emission factors also to fill data gaps when detailed data isn't available or would require a really disproportionate effort to collect them for low impact areas. So for example, if you are in a really energy intensive sector, you are a cement manufacturer or a steel manufacturer, and you're thinking about reporting on business travel, that's probably quite a low materiality for you. Or if you're a larger business and you have some sales officers, so getting the data from them could be based on spend-based emissions. So in this way, spend-based factors serve more like a bridge, ensuring continuity in your reporting. You maintain a comprehensive coverage, but you don't leave things out. You rather estimate them with spend-based emission factors, and therefore allowing you to focus your efforts and resources where they have the greatest impact. With that, it's important, though, to regularly review your materiality and determine whether emission sources have changed significantly over time. So we have seen that spend-based emission factors are used to help organizations get started, but also fill the data gaps. A question that often comes up while organization continuing with that process is what happens when you're ready to move on to more detailed activity-based methods, physical units. That brings us to an important consideration here, and that's how to manage the transition between methodologies. So when you transition from one methodology, usually more a high-level one, to a detailed one, no matter if it's spend-based emission factors or any other methodology, one thing to watch really closely is how it affects your reported numbers. So even if your actual operations haven't changed, switching to a more precise method can cause your emissions to shift, and sometimes significantly. So it's really important to communicate those changes transparently so your stakeholders understand the changes in reported emissions reflect an improved methodology, yes, but not necessarily a real-world impact. And depending on your company's rebaselining threshold and the changes in emissions, this kind of change in methods may require you to rebaseline historic data to really ensure you'll be able to accurately compare year on year. So to summarize this in a nutshell, spend-based emission factors can be a tool for you to understand your hotspots. They are valuable gap fillers. If you have smaller data gaps, that's really hard to close in short or even long term if they are not material for you. And our job as practitioners is really to balance between practicality and ambition and detail. So that means get started with what you have, focus on improving the most material areas, be transparent in your communication, and continuously refine your approach as better data becomes available. In the end, it's less about really achieving the perfect number immediately from the start, but more about demonstrating credible progress over time. And with that, I hand over to Jeff, our technical director, who will tell you more about the 2025 release of our spend-based emission factors for New Zealand.
Thank you, Katerina. So we're really excited to release the new version of our spend-based emission factors, which is called Emission Factors for New Zealand, Greenhouse Gas Emissions Intensities for Commodities and Industries. There's a few new things that are present in this release, and I wanted to touch on them over the course of the session. But the first thing to mention is that we've had them externally peer reviewed. The peer reviewer was Market Economics, which many of you might know as the organisation that produced the Auckland Council emission factors. I think it's worth keeping in mind that this is version 3 of our emission factors document. We released a version 1 back in January 2022. And then after that, the Auckland Council factors came through. We'd had another version which we released as version 1.1 back in May of 2024. And part of this release was really wanting to try to align with market economics to come up with a better approach so that we're all doing things in a similar way in the New Zealand market. And so a significant change in this version is how we manage the emissions flowing through to commodities in particular. There's fewer changes for industries, but from the commodity perspective, we're looking at a many-to-one mapping between industries and commodities to better account for commodities that are produced from multiple industries. And that was something that Market Economics had done through their work for Auckland Council and that we've now implemented into our own numbers as well. So the peer review is the first thing I wanted to comment on. The second thing I wanted to comment on is that the commercial version of our emission factors is now independently audited by McEwen Shaw. That audit applies just to the most recent year, which is the 2023 year. So I know it's a little confusing, but this is the 2025 release covering the 2023 year. There is a bit of a time lag associated with this information because we're relying on when Statistics New Zealand, when the Ministry for the Environment, when the Reserve Bank of New Zealand publish all their data. So that means we're we're operating on a time lag. The latest data set that we're using was published in early June of this year. So it takes us a couple of months to go through that process to update all the numbers and then to go through the audit process. So that's why it's being launched now. We still have the data for the previous years back to 2021, and the free version also covers 2018. But just to say that the audited version only applies to the commercial release for the 2023 year. We are running a promotion with this launch where you can get 20% off the list price. The list price is 2,900 New Zealand dollars. And if you do want to take advantage of that promotion, you can use the link below, ef.thinkstep-anz.com, and use the discount code there, SBEF20. It is case sensitive, just to mention that you can use that. If you are buying our emission factors through our reseller partners, then please go and talk to them directly. They can offer the same discount. So it's not exclusive to us as an organization. So in terms of what's changed and what's new in this release, at a very, very high level, the core concept is the same. These are spend-based emission factors calculated using something called economically extended input-output analysis. And that's just a fancy way of saying we look at the whole economy like a kind of a matrix. You know, industries are buying from other industries and industries are producing commodities. And effectively, we're using the emissions that are associated with a particular industry to work out the direct emissions of that industry. That number is fairly easy to get. And then really the use of this technique is more about how you calculate the indirect emissions, how you manage imported emissions from offshore, and how you translate from industries to the things we actually buy, which are the commodities. The release is two things. It's the report itself, and it's a spreadsheet that makes the data more available. The emission factors cover industries themselves, and there are two different classification systems that we use, NZSIOC and the ANZSIC classification. The core modelling is done at the NZSIOC level, which is a smaller subset of industries in New Zealand, and then it's mapped to ANZSIC. And then we use commodity codes where there's a much, much greater resolution of the number of commodities available. This particular method and the approach that we've used since the start when we first started publishing is a single country model. The reason for using a single country approach is that it's the closest to the data that we have in New Zealand. So we're drawing directly on data from Statistics New Zealand, from Ministry for the Environment, from the Reserve Bank of New Zealand, and we're trying to use the data, and transform it into the emission factors as quickly as we can to make that available to you. There are there are several different multi-country input-output models that exist in the world, and those are great where you might be a multinational enterprise, for example, and you want everything to be fully aligned across all your business units across multiple countries. But where your focus is more on the New Zealand market, then a single country model offers you greater resolution that's truer to the data itself. Often with a multi-country model, you're trying to basically make all countries fit the same mold. You're trying to make them all have the same number of industries, the same number of commodities often, and that means that you're having to do a lot of interpolation to get to the results. With a single country model, we can be kind of faithful to the classifications that are used within the New Zealand sector. But in the case of a small open economy like New Zealand, it is very important that we also be able to deal with imported emissions and to do that well. And for that, we're using a multi-regional input-output database called EORA, which is a global one. This is the first of our regular annual releases. So we started with a version of this white paper back in January 2022 that covered the 2018 year. We released another one in May of 2024, which covered the 2021 year. We've subsequently released as a commercial version 2022. This is the 2023 year of reporting. And moving forward, we're aiming to release every new version on the 1st of August each year after that data's come through and we've had a chance to process it and get it audited. So I mentioned before that there's a report and a spreadsheet. The reason that we need a spreadsheet is because life isn't always simple. So you're not often dealing with the kind of data that you absolutely need. So your reporting period probably covers a more recent year than either 2021 or 2023. And so it's important to adjust the emission factors to account for the specifics of what things you're actually buying. So as Caterina mentioned before, price is really important, and price fluctuations have a huge impact on the emissions intensities that you use. And so if you don't get the price right, you don't get the emissions right. And so our spreadsheet tool is relatively simplistic, but it does do inflation adjustment and it does do a GST adjustment where that's relevant. And so what you'll see in the spreadsheet, whether it's the public one or the commercial one, what you can see is the initial data, the data that we're actually providing, is in these blue columns. The adjusted data is in these sort of deep red colored columns. And what you can see at the top here where it says original is you can see what the original data that's being transformed is. So this is the public version, which only covers up to the 2021 year. The commercial version goes to 2023. But the public 2021 year, it's saying we're in New Zealand dollars, 2021 year in purchases prices, and I'll cover what that means in a moment, including GST. If you were wanting to represent the period, which is the quarter ending the 31st of March 2025, because that was your financial year, then there's a separate tab in the spreadsheet where you set that quarter up. And then if your accounts are GST exclusive, which they almost always will be, then you just select the option which excludes GST. And what this is doing is just transforming the emission factors into the right format for you to use, if that makes sense. There's different columns here: purchases prices, basic prices. We'll cover that more in a bit, but just to say that effectively the difference is that a basic price is kind of like buying directly from the farm gate or factory gate. It doesn't include wholesale, it doesn't include retail. As a result, there's no wholesale or retail margins. There's also no taxes. And so what you can see is that depending on how you buy something, the emission factor can be very different. So if you look at this first row, which is for living plants, cut flowers and flower buds, you can see that the emission factor for the 2021 year, this is inclusive of GST, is 0.102 kilograms of CO2 equivalent per dollar. The equivalent emission factor in basic prices is 0.246. And yes, that excludes GST, but that's well more than a 15% difference. And the reason for that is it's all the margins that go through the entire chain. It's all the other things that happen to get living plants and cut flowers to you through the retail, wholesale, directly to the consumer. There's lots of things happening, and as a result, there's lots of dollars changing hands as well. The actual emissions aren't going up particularly much. There is a little bit in terms of emissions from transportation, from retail, from wholesale, but they're relatively small. The key thing that's happening is the dollars are changing. The amount you're paying is very different to if you were to buy directly from a wholesale or from the farm or whoever's growing these things initially. So you can go to our website to download the new spreadsheet. You can go and download the new white paper as well. The methodology's been updated, and so the report's been updated to reflect that. But this gives a kind of a summary of what it looks like. This is the emission factors for commodities. There's also similar information for industries. So just to cover off some of the other things that are new, I've already touched on the fact that we've got a new method for commodities. The main change there is we've got many-to-one mappings rather than a one-to-one between industry and commodities, which is what we had before. We've also adjusted the method for imported emissions. We were always using the EORA database, but we're using that in a way that's better to try to more truthfully and faithfully represent the data from the global EORA database. We've also made some small improvements across the board to certain industries. So for example, fishing and aquaculture are split now, whereas they were combined before. The report's been updated to reflect the new methodology. There's quite a few changes in the report to reflect the new kind of equations that we've needed to use to do this. We have gone through that peer review process on the methodology, and then those commercial 2023 year emission factors are also audited now as well. So I just wanted to present a table to talk through some of the differences, and we'll cover this very, very briefly, but effectively, both methods provide emission factors for industries and commodities. A key difference is that the years covered are different. The free license is 2018 and 2021 only. The commercial license includes up to the year 2023. The whole methodology has been peer reviewed. There's no difference there, but the audit only applies to the commercial version because we have to audit a specific year. And the year that we've audited is just the most recent release year, which is the 2023 year. You can use both things in commercial projects without trouble, but you can't integrate the free license into a commercial software tool. So if you were using a tool like BraveGen, for example, you need to get a commercial license to be able to integrate the emission factors into that tool. We do also include some customer support inside the commercial license. We do provide regular updates, and if you're buying regularly, you'll get an annual update to the emission factors each year. You'll also get minor updates included as part of the initial purchase price. Both versions do adjustments for inflation and GST. Only the commercial version can adjust for the GWP methods. That allows you to move from IPCC, AR3, AR4, AR5 to the different methodologies to AR6. And only the commercial license allows you to split the emissions by different things. So you can split by scope 1, 2, 3, you can split by greenhouse gas, and you can also split by whether the emissions occurred inside New Zealand or whether they were imported into New Zealand. So I mentioned before that there are different types of emission factors, and I just wanted to touch on that very briefly. Effectively, there's industry emission factors and basic prices. Those are effectively like farm gate, factory gate prices. They're best for financed emissions. Commodity emission factors are available in both basic prices and purchases prices. Basic prices are that farm gate, factory gate price. Purchases prices are at the retailer or wholesaler, wherever you buy from. They include all the margins, taxes, other things that are being factored in there, and also the additional emissions associated with getting things to wholesale and retail. So if you wanted to choose an EF, how would you go about doing that? So we've got a decision tree built into the latest report. And effectively, you walk through the steps. So do you have suitable information and a suitable emission factor in physical units? So you know the emissions in ton kilometers of transport, or the liters burnt for the kilometers that were transported for something, for example, or kilowatt hours, emissions for kilowatt hour of electricity, or emissions for a liter of diesel burnt, or whatever it happens to be. If you have that, you should always use the emission factor with the physical unit, because that's not going to fluctuate by price. It's really linked to the physical relationship that's actually occurring there. If you don't have that, but you do have financial data, what do you do then? So if your focus is on financed or sectoral emissions, that's where the industry emission factors and basic prices make heaps of sense, because you're interested in a company who are in an industry, if that makes sense. If your focus is not on that, but it's on basically purchases in your supply chain, the question you need to ask yourself is, if you're buying direct, without retail or wholesale, directly from the supplier without all those extra steps, if you are, you want to use the commodity emission factor in basic prices. If you're not, and you're buying through retail, through wholesale, then you want to use the commodity emission factor in purchases prices. So that maybe gives a little bit of a flavor of the decision tree that you need to work through to choose an emission factor. So just wanted to remind you that the emission factors are now available. You can order at our website there, ef.thinkstep-anz.com, and there is a discount available until the end of the month, and that is also available through our project partners. So I'd like to just open up now for questions, and thank you for your attention. So we're going to go in and have a quick look through here. So we had a first question come in from Denny. Denny asks, the workbook provides quarterly inflation factors. Is there an expectation that organisations should be updating their spend factors quarterly rather than taking an annual average? And if so, why is the focus on this level of accuracy when spend-based factors are inherently inaccurate? The reason why we have quarterly inflation in the file is not because we think you need to update things quarterly. It's just because people have different reporting years. So if you're reporting with a year ended 31st of March, that'd be different to someone who's reporting end of June, end of September. And so we just provide the quarterly figures just to help people with different reporting years. And it's also the way that inflation tends to be reported by the Reserve Bank of New Zealand as well. So it's just to provide the same level of resolution that they provide. And those inflation adjustments, incidentally, can be updated by you. We update them annually when there's a new release, but in between times, if you need the newer value, just use the inflation adjustment tab, go to the bottom, and you just want to use, there's a table reference there. If you go to Stats.nz, you can find the right table and you can download the latest inflation adjustment and add it there. So we had another question from Matt. Matt said, are these emission factors applicable for Australia, or will there be a future equivalent package for Australia in the future? That's a fantastic question. I'd say, Matt, let's talk afterward. We're not producing emission factors directly for Australia ourselves, but we are entering into a partnership to deliver Australian emission factors too. And so that's something we should be able to announce soon, but can't talk through in detail today. But if you are interested in Australian emission factors, follow up with us. We do have a solution for that we're just working through the details of right now. But effectively, we're partnering with another expert Australian organisation who've been doing that work for a long, long time. Another question, the next question is from Liz, asks if we've got a Type 2 report available. We don't yet, but it's something that we're investigating. At this stage, we've just had the independent audit and peer review conducted. We'll look into a Type 2 report moving forward, but we don't right now. A follow-up question from Denny, would you then use the final quarter of your year for the inflation adjustment? What you do in the spreadsheet is you put in when your period ends. The way that our inflation adjustment in the tool works is actually midpoint to midpoint, so it takes the middle of the year to the middle of the year. But if you just put in the end of your reporting period into the tool, it will automatically do that for you. We had a question from Craig, which is, must each organisation purchase a commercial licence, or are there opportunities for networks such as the Carbon Neutral Government Programme or Universities of New Zealand to purchase a group licence? Our emission factors are currently licensed at an organisation level. If you do want to look at it at a group level, I think just contact us and we can work through it. We do distribute the emission factors through certain tool providers. So the likes of Kogo or Carbon Trail or others, and BraveGen are distributors for our emission factors. And so we can work through a solution. So happy to talk offline about that one. The question from Mike, is the McEwen Shaw spend-based emission factors audit report available to our auditors? The answer to that question is yes, from next week. So the audit has only just completed. It's been closed out, but we're waiting on the final QA report. We can issue that to you from next week. Question from Olivia, which is, can you please explain more about what you mean by commodities changing from a one-to-one to a many-to-one relationship? What that means is that in the past, we basically said that one industry produces one commodity. And often that works well. So if the industry just produces one thing, say it was the wheat industry, and the wheat industry was producing wheat flour, wheat for flour. If it was only doing one thing, that one-to-one mapping works quite well, and that's what we did before. The challenge that you've got is that when a sector is actually supplying things from lots of different industries, that's where it gets complicated. And there's quite a few commodities that are supplied multiple ways. So an example might be accommodation. You might have accommodation that's from a kind of the accommodation sector, but you could also have a farmhouse that's coming from the agricultural sector that's being let out. Or you might have niche consulting organizations that are supplying machinery to manufacturing companies, and they're actually taking inputs from a whole bunch of different industries to provide that commodity or that service. And so that's just something that needs to be considered. And so the benefit of a many-to-one approach is it's better able to account for those cases. Previous approach worked well where one commodity is produced from one industry, but in cases where a commodity is produced from multiple industries, it gets more complicated, and our approach couldn't handle it before. Now it does. And so in some cases that leads to significant changes. And just to the point that was raised by Caterina in her presentation, you have to assess on your own, what your own thresholds are for rebaselining. If the changes and the methodology are significant enough to mean that you're getting a large change in your reported emissions, it might trigger a rebaseline. And we do appreciate that that's a lot of work, and we don't want to put you through that process. We've been trying to work through this with the different organizations in New Zealand that are involved to try to come up with a kind of an agreed position, and hopefully we're getting closer towards that, so it's more standardized. Right, we have another question from Chen, and I'm conscious that I've been talking a lot, so I'm hoping Caterina can help me out with this one. So this question is, can you please give some more insight into how financed emissions can be calculated using the emission factors and basic prices? Do we need to get revenue data for each investment entity in order to use the emission factor, or does it need to look at sort of total emissions and gross revenue? Caterina, I wonder if you were able to help provide some insight into that one.
Yeah, thanks, Jeff. Let me just quickly reread the question again.
And so, I'll just read it out again for the audience. Can you please give more insight into how financed emissions can be calculated using the emission factor and basic prices? Do we need to get revenue data for each investment entity in order to use the emission factor? And then I didn't quite understand the last part, but...
Yes, but yeah, usually you need to have the investment data in each of the parts of your portfolio that you are investing to then apply the right emission factor for that right industry, so that you know in which industry it is operating.
Yeah, and maybe just to expand on that as well, just keep in mind that the emission factors represent the total monetary flow through the economy. So we're not interested in things like profit. We're really interested in that. It's more of a turnover thing. We're interested in total kind of transaction value. So you're wanting to focus on the monetary flow, if that makes sense. Right, and then we've got another question from Danny. Do you have any suggestion about spend-based emissions in the commercial construction industry? Did you want to comment on that one, Caterina, or would you prefer that I did?
Maybe leave that to you.
So there are emission factors that you can use which would apply to construction. I think you just have to be a little bit careful with how generalized they are. So one of the challenges that you have with any spend-based emission factor is that they're an average. And so quality is not something that you can kind of address through it because it is an average. So if I just use a different example that's not construction, then we can take it back to construction, from there. Hopefully it will help. So if you were to go and buy a bottle of milk at the supermarket, you could buy a 2-litre bottle of milk for, let's say, $4 if you bought a budget brand. But you could buy the same, like a much, much higher end bottle of milk, which might only be 1 litre or 1.5 litres, and it might cost you $10. In that context, if it's 2 litres of milk, irrespective of whether it's one bottle or two or whatever, if it's 2 litres of milk, the environmental footprint of producing 2 litres of milk is almost identical. But the amount that you're spending on those bottles of milk is incredibly different, to the point where the emissions are going to be incredibly different. And the emission factor that we have is only one number, and it can't account for whether something's kind of higher end, more expensive to deliver the same function as a different thing. And there might be small differences in emissions from the expensive one. The other one might be organic, it might be doing other things. But the reality is that the emissions will be relatively similar because they're all produced by cows on a farm. It's similar in the construction sector. When you're talking about raw commodities and things like sort of base crude steel and cement and things like that, they're more standardized in terms of pricing. But as soon as you move more down to the finished product level of a building, there's huge variability in the pricing that you're paying for different things. And there's lots of differences in finish and quality and other things. And there's also worth considering that in a particular sector, even if you're looking at, say, residential construction, residential might encompass detached residential, townhouses, and potentially even high-rise apartments. All of those things are types of residential construction, but they're very, very different in terms of their emissions. And so the reality is that a spend-based emission factor, while it will help you as like a thumbsuck number to say, hey, the total project is worth this, we multiply that by a value, we get an estimate, it's going to be very, very loose in terms of how close that matches to the emissions of your actual project. So if you do want to do building level footprinting, I'd really suggest that you jump onto a tool like the New Zealand Green Building Council's Homestar and Greenstar calculators. Their Greenstar tool for commercial building, for example, is freely available. You can put in the quantities for a building and you can get an emission out of that. So I'd encourage you to look at those kinds of tools. So and I'm conscious of time here. I'm conscious we're over time. So for those of you who need to jump out, please do. I'm sure many of you have already, but for those who are staying, thanks for your patience. We'll just try to get to as many of these questions as we can. So we had another question from Mike, which is, can you explain the difference? Go, Caterina.
One quick addition, Jeff, to maybe the last two. We talked about the construction industry. And so what we're seeing there, when companies actually switching from dollar spent data to getting the amount of steel going into a building or concrete going into a building, and really the focus is on the high impact materials going in. You don't need to have the full kind of bill of materials of the building, that there is actually quite a significant difference between those for some companies that went through that lately. And the other question, just coming back to that PCAF emission factor question about the revenue kind of for each investment, there are different levels. So the revenue is as part of it, but you might not need to know the exact revenue of it, but you definitely need to know the outstanding amount of each of these companies. So maybe the word revenue is the right thing, but you definitely need for each investment understand the kind of outstanding amount of that investment that you're having into that company and that dollar-based emission factor.
Thanks, Caterina. So next question was from Mike. Can you explain the difference between LCA methodology being used for spend-based emission factors and how they are alternatively calculated for scope 1 and 2? So if I understand the question correctly, the way that the calculation works is that Statistics New Zealand reports per industry on direct emissions from industries. And so there's a direct number there, which is this amount of total emissions and then this amount of total dollars. And so you can divide one by the other to get the kind of scope 1 portion. The scope 2 part in our calculations looks at the indirect emissions from purchased electricity. So we look at the electricity industry and the amount of emissions that contributes to that each industry effectively, and then ultimately each commodity. And then the rest of the emissions, when you get out to scope 3, is we're looking at all purchases of all things from all industries and across all commodities, if that makes sense. So we're trying to say this industry buys from all these industries, their emissions are whatever, and therefore you kind of translate through what the emissions of the different sectors are to work out a total. The way that the scope 3 part is calculated, it's effectively the total minus the scope 1 and minus the scope 2, whatever's left is the rest of the scope 3, if that makes sense. So we know direct, we know total emissions, direct and indirect, and then scope 2 is a particular calculation that we do. And I don't know if that answers your question, but hopefully that's helpful. There was another question from Arif, which is, could you explain how you determine the inflation rate? For example, if someone wishes to adjust the 2021 emission factor for inflation to apply it to FY 2025, the 1st of July 2024 to 30 June 2025, should they use the Reserve Bank's CPI inflation? So effectively, what we've done is we've built into the tool CPI inflation rates. We've got the data in there quarterly. They're the kind of chain measure ones rather than the like point to point. So they're building on each other relative to a fixed reference year. Effectively, what we're doing is we're looking at the difference between the midpoint of each year and the midpoint of the previous year. So if your financial year was 1st of July to 30th of June, we're effectively taking the end of, so if this was 1st of July 24 to 30th of June 25, we'd be looking at the 31st of December, or the end of December 2024. That'd be the midpoint of that period, and we'd be comparing to the midpoint of the reference period, if that makes sense. And the reference period of our data, because of the way it's released by StatsNZ, is the calendar year. So the data set is based on a calendar year, not a financial year. And so we'd be adjusting then for the middle of the year, if that makes sense. So that's the way it's calculated. And I think that might be the end of the questions. So yeah, thank you all for your time, and we'd like to thank you very much for attending today, and we hope you all have a wonderful afternoon. So thanks, and bye from me.
Thank you. Bye.
We have many more webinar replays on a whole host of sustainability topics. You can check them out on our website and our YouTube channel.